Thank you. So the 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 topic du jour is capital allocation in the oil and gas space. It sounds wonky, technical, but I can't think of a more important topic to discuss in this conference, and I can't think of better speakers than my dear friends Louisa and Ilmi, who will introduce themselves. And after that, I'll frame an opening question, and then we will go wherever our guests want us to go. So maybe we can start with you, Louisa, and then we go to Ilmi. Just a brief introduction in terms of who you are, where you're coming from, just to inform your comments and your perspective.
Thank you, Shiva. Thank you so much for this invitation. So, my name is Luisa Palacios. I'm a senior research scholar at the Center on Global Energy Policy at Columbia University. I'm also an adjunct faculty at the School of International and Public Affairs. Prior to my 2 year as a senior research scholar at CGIP, I was the chairwoman of CITGO Petroleum Corporation, which is an independent, the fifth largest independent refinery company in the U.S., which is owned by a national company. Prior to that, I spent actually most of my life in the financial sector, working for banks and for different kind of banks, U.S. banks, multilateral banks, and European banks, covering mostly oil exporting countries and national
Ilmi,
companies.
thank you, Louisa.
Hi, I'm a senior fellow at the Sabin Center for Climate Change Law at Columbia Law School and a senior visiting fellow at the London School of Economics, a principal at the Strategic Decarbonization Advisory Firm Climate Technology Group, and a non-executive director at Carbon Tracker Initiative. My own background varied like Luisa's. Was a practicing attorney for a number of years in finance and have also worked in development finance to complement the Wall Street Times. So I'm a bit of a finance generalist. And most recently created and ran the finance program at the Climate Works Foundation.
Amazing expertise, as will be obvious in the next hour. So let's kick this off. Let's say you're the CEO of, and I know across the Atlantic, the social political contract is different, but let's say Chevron. And if you're not comfortable with names, we don't. Let's a fictitious large oil major in the U.S. and a fictitious large oil major based in the Netherlands, listed in London or whatever. What should you do in terms of capital allocation? And just to kind of set the stage, on the one hand, when some of these companies complain about cost of capital, I wonder then why are you buying back shares? I mean, oil is at relatively high prices, like 75 odd dollars a barrel these days. So you're flush with capital. On the other hand, both sides of the political spectrum are unhappy with you as a CEO. The left is complaining you're not investing enough in renewables. The right, at least in the US, is vociferously complaining that you're not investing enough in oil and gas production, and that'll lead to energy security issues. We know, for folks who are not familiar with the oil market, 60 to 65 odd percent of oil is basically produced by non-Western democracies. That's a well-known fact. The Aramcos and the Rosnefts, and some are regimes that are friendly to the U.S. and the West, and some are not. The IEA and the IPCC have all these scenarios in terms of where the world is going. Our own president has been asking people to produce more oil. It's a very confusing time. So just to kind of frame the conversation around a question, as the CEO of an oil major, what would you do? We start with Louisa, then we go to Ilmi, and then we go wherever the conversation takes us. Louisa.
So, difficult question. So, I think it's difficult to start answering the question without giving a little bit of history, right? And so one of the things that has happened with oil and gas companies, and even assuming that I'm the CEO of one of these companies, is that we've actually had very bad performance during the last decade. Our performance has been, on a risk-adjusted basis, even worse when compared to any other sector, and when compared to the general returns of any company, any sector in the stock market. So I think that COVID accelerated that conception about or that understanding about capital discipline and that focus about capital discipline. And so to be, I think, accurate in a description about what capital discipline means, this is not only about stock buybacks. This is also about increasing dividend payout, and this is also about deleveraging. And so you did have a significant increase in debt. You had a significant, or at least a liquidity position of a lot of these companies was highly affected during the pandemic. So to me, the fact that at least at the leveraging part, the significant strengths of liquidity position as seen by free cash flows position of these companies makes total sense from the point of view of recovering from the COVID pandemic. The capital discipline component linked to dividends and stock buybacks, I think, has to do also with the fact that the sector has really been an underperformer for quite some time. That said, part of the capital allocation question that you're asking is also about CapEx. And the real question here is about why hasn't there been a more important increase, a more important reinvestment of profits on CapEx? And that is a much more complicated question. And I think also, to me, there's a lot of rationality in the answer. CapEx has been increasing. Let's be honest. CapEx has been increasing, but it has not been increasing at the level you would have expected, given the level of profits that we have seen. In other words, and I think it's important to specify the caveat here, oil and gas companies from the advanced markets are not investing at the same level they have been investing in previous very important or high oil price cycles. And to me, that is also a rational decision based on significant uncertainty about the oil demand outlook, about the fact that these companies are actually taking seriously the policy signaling from countries and from regulators about the climate commitments, about net zero pledges, about the need to phase down oil and gas assets. So I think that a more important question not only is about the how much capex are you having, but where is that capex going as well? And what I see about capital allocation in this industry, I would say, is not only what they're doing with the capex that is going in the oil and gas space, but also the kinds of decisions that are being taken in relation to the capex or OPEX that is going towards decarbonization and low carbon solutions. And so let me just take the first one. So one of the things that we can see is that you are indeed having a rethinking about how much capex that should go into exploration versus how much capex should go into just regular development and production of existing assets. That, to me, is also consistent with the fact that an agency like the International Energy Agency is saying that in order to meet our climate goals, no new oil and gas investments in new projects that have not been FID, which is have not been subject to final investment decisions, should be undertaken. Because what we have, the oil and gases that we have, are consistent with the oil and gas that we actually need, even in net zero. And so a shift from exploration towards production makes sense to me from the point of view of a decision that boards of these oil and gas companies are making. The second decision is about the optimization of your portfolio. You are seeing a lot of companies deciding on moving away from certain areas into other areas, particularly into low emitting assets. And so that is leading to actually other kinds of problems because it's leading to transfer emission problem. But from the point of view of these oil and gas companies, optimization of the portfolio towards low emission assets makes a lot of sense. Also in line with the signaling about the future oil and gas demand. And the third thing they're doing with their capex is shifting from oil to gas. That is also very consistent with the fact that in the oil and gas demand scenarios and even net zero scenarios, there's a little bit more visibility about natural gas, even if there's questions about whether it is a transitional fuel or not. But there's much more visibility about natural gas demand than there is about oil. So that shift makes a lot of sense. Let me stop there and have Ilmi join the conversation, but I have other things to say about other aspects of decarbonization and green CapEx.
Ilmi from Sweden.
Yeah, greetings from Stockholm, where I'm based now. Lisa, that was really great diagnosis of the situation that these majors find themselves in, and I want to build on that rather than repeating it. Although I agree with the vast majority of your diagnosis, I would hate to be, even with record profits, I would hate to be the head of a management in an oil company. And the reason that I say that is, Luis is right to point to the context of the last decade of underperformance of these companies relative to, say, the S&P, and I think the reason that you saw nearly unprecedented free cash flows and very little investment in CapEx is that there is not just uncertainty, but there's increasing certainty that demand is being destroyed by techno-economic change and policy. And I want to point to both. And so the reason that I wouldn't want to be a major is this. And we can unpack this later. I want to talk later about demand destruction and what the signals are there, but also talk about volatility. We're on this path of decarbonization and substitution of technologies that don't require oil to technologies that don't require oil, and but it's going to be a very volatile path. So there's going to be moments of high oil prices and opportunities to be profitable in that context. Those are really interesting, obviously, from the perspective of being a manager. On the other hand, you're in a shrinking industry. The reason that I don't envy a manager is this. What is clearly going to be the best for shareholders is the managed shrinking of your business, unless you pivot to a new business. That's clearly going to be in the best interest, and that's why Luis pointed to dividends and share buybacks, or what I call auto divestment. And so these are great tools for managing the retreat of your business. But nowhere in the Wolf of Wall Street structure of our capital markets do we reward CEOs for shrinking their business. So even if that's in the best interest of the shareholders, which is what management should be focused on, we haven't figured out how to uphold the successful navigation and like maximizing the value to shareholders over time of shrinking the business and successfully navigating this transition. And so I actually don't, the reason I don't envy managers is because what the direction of travel is clear, but the psychological and cultural incentives are not lined up to enable them to do that. So they're stuck pumping their business and trying to figure out what the heck to do about it. And if you were clear-eyed, that would be the fundamental problem, in my view.
Okay, so that's a lot to chew over. I was desperately trying to keep up. But one of the things that struck me was Louisa characterizes this as uncertainty, and Ilmi, you're convinced that they are in a secular decline. That itself may not be clear, but and we can pick that up if you want to. So let me raise a couple of issues, and we can always go wherever you want. But the history of companies killing their main product and switching to the next alternative is pretty poor, right? Blockbuster had a chance to buy Netflix twice and they passed. And there's so many examples, right? IBM is a good example. They had Watson, they had AI way before anyone else. Xerox, Kodak, the list goes on. So should these oil majors even bother with all the new stuff like hydrogen, CCS? They claim they're going to become energy companies like BP. Is that even a sensible strategy given the cultural baggage? Is one issue to worry about. And the point that you made, Ilmi, is brilliant. I have to rack my brains and think about how do you compensate a CEO for rationally shrinking a business, assuming you're convinced that there is going to be secular decline. which itself may or may not be true, right? Have we really given customers an alternative to oil? Are we overdoing pressures on the supply side? We rarely tell people switch the lights off in case you're out of the office, for instance. And there are many more examples of what could be done on the demand side. So let me just leave you with that. Maybe you start with Louisa, then Ilmi, and then we can have a back and forth. Louisa.
So this is indeed a fascinating discussion. So I don't think that everyone has the same view. That is, I think when what we're talking here is about the majors. But the oil industry, the oil and gas industry, is a patchwork of different kind of companies with different kinds of incentives, including national companies, which believe they're going to be the last barrel standing, and therefore have much less incentives to pivot their businesses to anything else. We have independent exploration and production companies, and we have the integrated oil majors. And so sometimes I think we probably need to differentiate who we're talking about. And so let me just take this concept of this is not a growth business, and therefore, if it's not a growth business, then you're promising shareholders is dividends. You're promising to be a cash stock, not really a growth stock. And so, again, this is not necessarily because you are driving I think that concept is fascinating. I'm not sure that they're thinking like this. I actually think that a lot of the decisions being made in the oil and gas companies today in the advanced world have to do with believing that they're going to be part of that last oil barrel, that their company is going to be part of that last barrel. Whether they are right or wrong is a completely different thing. However, they are indeed adjusting to a different kind of world. So if your world is not about growth and therefore not about higher oil production every time, then you need to get a higher yield on your barrel. And therefore, you shift to a world where the energy transition, you actually like to be in a world where the energy transition is not really driven by demand and therefore by collapsing oil prices or gas prices, but driven by supply. So supply is adjusting first because that gives you a higher yield and therefore higher value for the barrel produced today. But that said, I do think that regardless of whether in what business you are and whether you're pivoting or not, everyone has a responsibility to decarbonize because we have a limited carbon budget. And therefore, every single oil and gas barrel produced today has to be the least decarbonized possible. And so one thing that I do think is whether you can be a solar producer and a wind producer, I actually think that's a fantastic question, Shiva. I do not think that a lot of these oil gas companies should pivot to be wind producers. This doesn't make sense to me. That said, I do want them to use their balance sheet then to become the makers of that market. And so I want them in their scope 2, by reducing scope 2 emissions, to buy a renewable energy. And so there are many ways in which you can participate in the energy transition. One of them is pivoting yourself, but another one, which is what they're doing in their sustainability reports, is showing how their scope 1 and scope 2 emissions are declining. And if you are outsourcing renewable energy, that's not CapEx, that's OpEx. But that is equally important in terms of contributing to energy transition and contributing to the deployment of green energy.
Sorry,
Ilmi, it takes me a while to unmute my mic. Go on.
No, it's great.
Don't wait for me, just go.
No, got it. Yeah. So, I think Luis has highlighted this free rider problem. Every CEO in every industry wants to get more market share, and that's kind of the way capital markets work. And everyone has overly rosy picture of their own ability to be the entrepreneur capturing that market share. So everyone wants to be the last barrel, when we all know it's going to be Saudi barrel. Right? That's why I've always told activists, don't focus on the Aramco, IPO, et cetera. It's very sweet oil, and it's much more complicated to talk about that versus other producers. In any case, I think that's right, and I think that the public interest problem from that is that that will create a lot of value destruction, that approach. So it's rational from the individual actor's perspective. It will create a lot of value destruction, and that value destruction will create a lot more emissions. So you get this terrible combo of it being economic value destroying and emitting. So I think that's highlighting that problem. Look, whether Mike Liebrick has a great article where he has like sort of two options for the oil industry, and this is really the seminal piece. Is he calls it like the Vicar of Bray, or riding off into the sunset. Like either you pivot the business or you have this managed decline. I think the prospects for any individual oil company to pivot and do the kind of Orsted move is very low. It doesn't mean that there won't be more. Kodak didn't pivot. Fujifilm, I think, used their collagen technology to get into like cosmetics or something. So they did pivot based on their comparative advantages. I think there are some that are available technically for oil majors. I mean, besides the fact that they sit on a bunch of cash, which they like to parade around and say we're good for the transition because we have healthy balance sheets. I think that is missing that. There's specific technical areas where they're strong or not. So there's been literally in the last 24 hours a huge breakthrough in enhanced geothermal by Fervo Energy, the founder of which came from the oil and gas industry and found technologies there. There's a lot of technical advantage in geothermal, whether it's conventional or enhanced, that the oil and gas industry has. And I think the potential for geothermal to be a very significant part of the energy mix is really high and unexplored. I think the advantages that oil and gas has for solar are very low, other than having cash around to spend on something. And so it doesn't kind of match up. Maybe offshore for some oil companies, offshore wind is there's some parallels, but it's a pretty different industry. And then when you've talked to the oil industry about shifting to electrons instead of hydrocarbon molecules, they go, well, look at the returns. They're only 8% and we get 24. And you're like, okay, you've picked the peak IRR that you've ever gotten. And it doesn't look like there's there's not a lot of prospects for that in the future. And that 8% is risk adjusted and far less risky. So it's just a different business. So there is a mentality problem, even if they have the technical chops to pivot to renewables, that what you're looking at is lower and lower risk returns in an industry that is used to high yield, high risk, and looks a lot kind of more like other extractives or something like that. That's the sort of the model. And so I don't know that you have the stomach and culture for it. I think there will be a lot. I will point below the level of the CEO. I think there are lots of opportunities for technicians from the oil and gas industry to go into other sectors and fields. And I think that's a really good idea. That's different than whether these individual companies will manage that transition. And I'll say, I also don't care that much. I don't really care about any individual company except for the one that I'm working for. So the idea that like we have to manage the largest companies now into the zero carbon world is a little bit naive. I'm a bit more Schumpeterian in my belief about how productivity and economic growth happens, and whether it's this company or a new company that disrupts it to create the goods and services that people want in the next 10 years versus the last 10 years is kind of neither here nor there. I hope that we have a adequate adequate labor market to find all those managers good jobs or retirement, comfortable retirement, and that's fine. These may not be the companies of the future, and we should be comfortable with that. And I don't think we owe anything to the existing companies that they should be, the big companies of the future.
So if I may, again, lots here to unpack, but I'm still catching up with some of the introductory comments. So help me sketch, if you will, how the demand scenario would actually pan out. I've looked at the IPCC's things and IEAs, and you're experts, obviously. So if you look at, say, energy intensity, roughly defined as, say, emissions divided by, say, some proxy for output sales or cost of goods sold or something, the change in that number is glacial, very slow. You're lucky if it is like minus 1% per annum. This is for the whole economy. China, of course, is doing faster things. If you look at the US, it's pretty slow. So this is a very slow moving process. Yes, it'll eventually happen, but if it happens 50 years out, as a CEO with a horizon of 6 or 7 years, or as a board with a horizon of 7 or 8 years, I frankly don't care. It's like 3, 4, 5 terms away. But even before we go into the incentive issue, which Ilmi you alluded to, just let's do some very basic scenario planning, right? So the intensities are kind of falling slowly. Maybe the EV adoption will be the big thing, Schumpeterian shock that you mentioned, maybe in 2030 and so on. If most of the new cars in the Western world probably have to be EVs, at least in California, and certainly in Europe. Hopefully, the rest of the US will catch on. Is that the shift where a lot of the oil that's being used for maybe gas run cars, combustion car, engine falls? Is that like the big thing, big shock than we expect? But for industrials, etc., it'll probably be a slow fall. Another point I want to make here: if you look at Exxon and Chevron's scenario analysis, it's fascinating. So they say around 2040 or 2050, most of the money will be made by selling chemicals. Isn't chemicals coming from oil? I mean, I'm no engineer, but is it a sleight of the hand, or based on everything you are aware of, just help listeners figure out what would this demand evolution look like, if you can.
Great question, Shiva. So I think maybe it's useful to understand where primary energy requirements today, about 80% of them come from fossil fuels. That's what the matrix looks today. In 2050, that will fall to something like 30%. And so what we're looking at is this is a product, or this is this used product that had a monopoly over energy. In 20 years, in 30 years, that monopoly, they will continue to exist, but that monopoly would have disappeared. If everything goes as according to what people believe is going to happen, then you have a series of different technologies that will provide energy. And therefore, going to Ilmi's point, therefore, it's that sector that has 70% or 80% is now going to be 30% or less, or 40%. And so who is going to compete? Who's going to be the provider of all the other technologies? And so when I look at how exactly the waterfall graph of how exactly we're going from one place to the other, yes, what we're seeing right now are the more mature clean energy technologies, solar and wind. Now we're moving into transportation, electric vehicles. What are the other technologies of the future? They are CCUS, they're biofuels, they're hydrogen. Actually, those are the three that oil and gas companies have a competitive advantage on. So that they have not shifted today doesn't mean that they're not going to shift tomorrow. That's one thing. But Ilmi's completely right. There are a lot of skill sets within the oil and gas industry, whether it's these companies or other companies that are formed, it's a different issue. But carbon capture and storage, this is something that the oil gas industry invented, which was called differently because it was for enhance oil recovery. Hydrogen, for example, one of the main clients of hydrogen are refineries. And so if you think about how do you create markets, the first customers are the refineries. So refineries should be moving towards creating themselves the green hydrogen, because then that will give them a first mover advantage. There are oil and gas players in the CCUS market. There are oil and gas players in the hydrogen market. There are oil and gas players in the biofuels markets and low carbon fuels, where not the light vehicle are placed, which is already, there's kind of a clear idea that electric vehicles is the technology for light duty vehicles, but it's not probably the technology for heavy duty vehicles. It's not the technology for aviation. It's not necessarily technology for shipping industry. And so those other sources of transportation are also going to have their own technology, and some of the things that the oil and gas industry used to do could actually be pivoted to that. So that we have not seen a significant pivot today does not mean that we're not going to see some companies pivoting in a more important way in the future. But that said, to your question specifically, you have refineries, right? And there's refineries can either produce fuels, and we know that most of the emissions that take place in the oil and gas industries take place in scope 3. It is the burning of that fuel, right? So when you look at the oil demand scenarios in 2050, you still need oil. What do you need oil for? You need oil as well for petrochemical industry, for the chemicals industry. So integrating refineries into chemicals is actually one of the ways in which you pivot. The oil and gas industry pivots because then you avoid the scope 3 part of the burning the fuel, and you integrate into plastics. That doesn't actually completely eliminate the emission. You still have emissions linked to plastics, but it's the burning part of it you do cope with. And so I think that there are different strategies. What is clear is that the energy of the future looks very different than the energy of today, and therefore the industry of the future will look very differently.
Yeah. I think I agree that there's going back to Lisa's original comment, I agree that there's uncertainty, but it's kind of like the uncertainty, imagine a car is like on slippery ice, the brakes don't work, and it's like careening out of control. Like, yeah, there's uncertainty as to whether it will hit the tree there or like a rock over there, but it's going to crash. Like, we don't, the direction of travel is clear. So let's be clear about the nature of the uncertainty. I think Lisa's right. We're going to have a really interesting and different energy mix. Hydrogen is not going to save the industry by creating a magical fuel that replaces all the current applications and the current structure and won't save the upstream industry or the downstream industry. But I think part of the reason that we get confused around some of these alternative fuel supplies is that we want to tell the story about renewables as a replacement of supply for supply from hydrocarbons. And I actually think of the story a little bit differently. I think it is a story about demand destruction. And I think the real story that the oil and gas industry has to face and the hydrocarbon industry has to face in general is one of demand destruction. And what I mean by that is, a thermal power plant is a supplier of energy for the economy, but it's also a demander of fossil fuels for coal and gas. And in some economies, oil as well. We had this substitute with where that was capex and almost no opex from renewables and wind. And if you hear the story of the coal industry 10 years ago, they were like, no, we're in cyclical decline, not structural decline. My buddies at Carbon Tracker Initiative, where I'm on the board, raised their hand and waved it around and said, no, this is structural decline. And we'll show you why. And they said, no, it's not. Look, it's just this look how little solar industry is. It's just this little wedge. And the way that nonlinear change happens, once that ate up all growth in the industry, the market really started to reprice the value of these thermal assets, and you're off to the races. I think that the thing with gas that's interesting is that I think it was a transition fuel. I think we were right when we started saying it, and then it's already happened. And we've been saying it for about a decade and a half, and it was about 8 to 10 years, maybe 2 decades. It was about a decade, a little more, where it served as that transition fuel, and we're now at the end of that process. For the last 5 years is sort of the tail end of that. So we're not in the transition; we've crossed the bridge. But the reason I point to that demand destruction story is that I think solar and wind give us the harbinger for transportation. which is going to be nonlinear as well. So we'll see this small wedge that will grow very quickly. And I want to point to a few cool facts to illustrate this point, to underscore the direction of travel. Carbon Tracker did some very conservative, very linear growth models of EVs that suggested that by 2030, you'll have 60 to 70% of new car sales, or about 25% of the fleet in EVs. That constitutes, by their estimate, about a third of light duty vehicle oil consumption lost over between now and 2030, a third of light duty vehicles. That's a very big hit to the industry's existing structure and existing demand. But that analysis was before it got supercharged by public investment. And that public investment is investment in CapEx that replaces oil demand and other fossil demand, and is designed to spur on commensurate private investment in CapEx that replaces this demand. So a related fact, that number is sort of a third of light duty vehicle oil consumption demand between now and 2030. But then you have the IRA come in. And I want to look at batteries for a second, because to me, batteries are what is, the equivalent of a coal-fired power plant is not a solar panel. The equivalent of a coal-fired power plant is an internal combustion engine. and coal-fired power plants were replaced by solar panels and wind turbines, and ICE vehicles will be replaced by batteries effectively. And if you look at the US's the existing battery capacity in November 2021, it was 55 gigawatt hours. It's a good chunk of battery capacity. As of November, this is according to Argonne National Laboratory Research, as of November 2022, a year later and after the IRA was announced, the announced capacity, battery manufacturing capacity in the US alone, was a terawatt hour. That's a terawatt hour per year produced by 2030, 800 gigawatt hours of which would be by 2025. Now, that may not all happen. Not all announced projects get completed. But even if a fraction of that happens, the amount of cheap batteries that will flood the market and substitute for, starting with internal combustion engines, but other applications as well, really fundamentally changes the landscape. And I could go on. You look at the estimates of global auto EV investment, and according to the current cost of manufacturing of a vehicle, if you were to just maintain that, over time with no learning by doing of making EVs, the amount of announced EV capacity would be about half of all cars produced. And if you have the forecasted S-curve of EVs, it equates the amount of announced EV capacity globally from auto OEMs is the amount of all cars produced now, 80 million cars per year. So you have this wave coming, and then it's supercharged by public investment. And so, yeah, there's uncertainties, but is the oil industry going to find refuge in some radically growing demand for petrochemicals? No. Is there going to be demand for petrochemicals in 2035? Yeah. But is it going to replace light duty vehicles, a lot of heavy duty vehicle applications, maybe even some other applications like short haul flights? And I'll tell you, if I have a choice between a $10 flight from here in Stockholm to Morocco or a $2,000 flight to Bali, I'm going to take the $10 flight to Morocco because I don't have to pay for any jet fuel. I think that might change the structure of the market, but that's speculative. The point is, you already have built into existing policy and techno-economic change a pretty huge demand destruction, and we don't even have to be speculative about the next frontier. I will make one speculation, though, before I shut up, which is that once you have that kind of battery investment, and once you have that kind of EV investment, the political, social, and economic cost of regulating emissions, whether those are conventional pollutants, carbon pollutants, or regulating 100% battery electric vehicle mandates, zero ICE vehicle, banning internal combustion engines becomes very politically cheap. If you're in a $80 a kilowatt hour battery world, the political costs of zeroing out demand through regulation starts to become very, very attractive. So that's why I'm pretty confident about demand destruction in the medium term. And in time horizons, it doesn't matter about 2050. These are all time horizons that affect CapEx decisions now. As I was a project financer, if you plan a project now, if you put it in your capital plan now, it takes 2-3 years to permit the project and develop it. Project financing is not that easy. It's online in that critical window when that demand destruction is happening, which brings us to the question about exploration versus producing existing assets.
So let me pick up on something you said, the political climate. So we just went through ESG month in Congress. There are like 12 bills that the Republicans have. And, I spent some time hanging around there, and I couldn't help but notice the absolute vociferous, I don't know what to call it, denial, or why the fight? I mean, are they talking to different advisors, not to the two of you? I'm sure they're smart people, but why this insane opposition to keep things the way they are without seeing the writing on the wall and having the next level conversation about what should I do to prepare for such demand destruction? Is it just a political kabuki dance? Is there something deeper? Are there real differences in how people think the world will evolve? Or just a quick thing, what is behind this this tsunami of opposition, if you will, from the fossil fuel producers, anti-ESG, there'll be energy insecurity, we'll have a Sri Lanka on our hands. These are the kind of scenarios that are being touted in Congress. Who's wrong and why? Maybe Louisa and first, I need me then.
So, I think it's important to clarify certain things. I think the direction of travel is clear. I think there is significant uncertainty about the speed, and we can argue about the speed of travel, but it makes a difference in terms of how fast do you think you have to pivot, and maybe capital allocation decisions that take place between here, the next 10 years or not. And so that tells you the direction of travel, and the speed of energy transition tells me that Shell and BP deciding that they were going to scale back somewhat their declines in oil production, their capex for oil production, I think is more about the immediate transition period from here to 2030, maybe 2035. I don't think they might question the direction of travel, because energy transition scenarios are very clear about what, and I think it is completely correct in this idea of demand destruction. That's what the net zero scenarios of the IAS are telling you. We consume today 100 million barrels per day. In net zero, we're supposed to consume something around 30 million barrels per day. And yes, all of them are going to be produced by Saudi Arabia, apparently. But that is what they're actually estimating. It's not, that's their net zero scenario, which is an aspirational scenario. They have another scenario called the announced pledges scenario, which what they do is that they take into account the pledges and commitments that all countries have made today about their decarbonization goals and commitments, and they then model oil demand and oil supply accordingly. That scenario also has declines of oil production, natural gas, not the 75% decline of oil production, not the 50% decline of natural gas demand that they see in 2050, but they do have both declines. So Ilmi is absolutely right. This is about demand destruction in different energy transition scenarios. It depends on the speed at which you think you're going. So I do think that that's part of the discussion. The discussion is about a perceived understanding that we have gaps, that the oil and gas industry might be adjusting too fast, that CapEx is not keeping up with demand, and as the same headlines that Ilmi is underscoring, today the Energy Information Administration is actually talking about increase in oil demand that they're seeing in 2023, 2024. That's the Energy Information Administration, the U.S. Department of Energy. So I think that the direction of travel, I don't think that this is the discussion. The discussion is about the speed, and therefore, how do you, as a policymaker, not only as a CEO, as a policymaker, you just have to make sure that you don't have huge mismatches, because I think that there's a concern that when supply adjusts faster than demand, this is a price-driven transition, then can lead to, in the short term, maybe not in the long term, to a decline, political decline for the energy transition. My sense is that at the same time that you have that headline, you have the headline of heat surpassing anything that we have seen, extreme weather events that are only, I think, compounding voters and consumers' awareness of climate change and this impact. So I think that regardless of the modeling that we're doing, I think this is going to put a lot of pressure on companies and their ability to continue to invest in a significant way on supply, regardless of energy security considerations. So I think there's a lot going on, but I think the discussion and the politics is really about the next 5 to 10 years, not necessarily about the next 20 to 30 years.
Ilmi, will we end up being Sri Lanka?
This is the first spot. Yeah, this is the first spot where Luis and I disagree because I think Luis is way too generous as to what's going on. I think what we're seeing is insanity, and I think we're seeing the insanity of a cornered animal. Financial markets are retreating from fossil fuels in various ways quickly and for economic and financial reasons. And the Republican House is trying to forestall that because its donors don't like it. And so you have, if you can't win fair with the functioning of the capital markets, you try to win dirty. I would never look at EIA statistics, honestly, as a reliable forecast because they have a terrible record of forecasting these things. So that I do appreciate it's a pretty powerful institution, but pretty bad at forecasting. And I would say that, in terms of trying to read the tea leaves, obviously the future is always uncertain, and that's the nature of life and the capital markets. But I would say, look, I think of it this way. I think announced commitments announced pledges are far too conservative. And I would point you to a project that I got to work on called the Inevitable Policy Response that had a scenario, a scenario called the Forecast Policy Scenario, which tried to build a combination of techno-economic disruption and consequent policy change. And I alluded to that point that, when you're in a 200 kilowatt hour battery world, it's a different policy context than a 100 kilowatt hour battery world. So, look, would we be talking about some of the policy opportunities or techno-economic change that we're talking about now 5 years ago? No, because the technology was still evolving, and so the available policy changes. And so, just what policymakers are willing to do now doesn't tell you what they'll be able to do in a very different techno-economic environment in 10 years. And so I think, that forecast policy scenario puts us at about 1.8 degrees by the end of the century, but that's not based on whether we committed to 1.5 or 2 or 2.5. That's just based on that interaction of techno-economic change and policy and social change. And as a plot, now you don't have to believe that that's the view. And no one would take any sell-side analyst's view and invest on the basis of a single view, but it is a really important input to kind of have a clear picture of the future. So I don't think it's in good faith. I think it's just trying to fight the economics that are now inevitable. And I will make the observation: it's hard to forecast these changes to demand because policy is uncertain. But here's an important difference. And I think this is actually part of the reason why the payees of the industry are so afraid. Is the interesting thing about public investment as a policy is that once the money's out the door and it starts to change the economics of the industry because of S curves, you can't repeal that. And while it is true that we don't know whether one administration or another will try to enact, you know, fuel efficiency standards, or replacing boilers in homes or whatever, we don't know what things are going to get prioritized. The policy context, once those S curves have been descended, becomes completely different for all actors. And so I think, if you look at the IRA, which is somewhere between 370 and $1.2 trillion of public investment, depending on whether you believe government estimates or you believe Goldman Sachs, is going to change the techno-economic environment. And once that money's out the door, the rules change. The underlying rules change, and there's no policy vicissitudes that change that. And if you're really deeply invested in an incumbent industry, that can be a bit scary. The only industry that's really directly at risk is fossil fuel supply, and I guess the chain of fossil fuel supply from upstream to downstream. Extractives have a clear pivot. Steel, cement, and other industrials have opportunities and pivots depending on the company, but within the sector and industry. Autos have a pivot, et cetera. But it's tricky for this industry,
Okay,
and that's
so
unique.
a producer is telling me I have 9 minutes left. So, I come from an emerging market. Louisa, I'm sure, has experiences with an emerging market scenario. And you may not be familiar with India. India is deeply complicated, a continent into itself. But if you are writing the energy policy for a country like India, which basically has very little money, adaptation is probably the only option. The crazy heat waves in Calcutta, huge floods in Delhi. What do you do? What should your? I mean, it's obviously a defensive strategy, but if you were to say advise the energy secretary of an India, or maybe even in Indonesia, which is an oil producer. How do you deal with this, Louisa, Ilmi, and then maybe we'll go to final comments to close out.
So very rapidly, I mean, one of the realities is that most of the energy demand and oil and gas demand is really going to come from emerging markets in the future. This is not about advanced economies. So whether we meet our climate goals or not depends exactly on what India, China, and other emerging markets do with demand and with supply. So I'm equally concerned about the decarbonization of supply as I am about the significant increase in demand. And so I am more concerned about that. The problems that I see as well is that not only is about the oil and gas industry, it's about the coal industry in Asia Pacific. So one of the things that happened and one of the results of the energy security issues that we had is that significant increase in coal. And those are new assets, which are stranded assets, so that to me is even a much more complicated picture because that you actually invested for assets that now need to run for a much longer time. So you are locking in emissions. It's not easy to do energy policy in a place like India with the growth that it has and with energy reliability and energy security at the cornerstone of this, even in the context of India deploying the significant amount of renewables that is deploying. And that is, I think, the problems that exist all over the emerging markets is that these clean energy technologies, and Ilmi, you're completely right. You have the balance sheet that is provided by the U.S. government in the form of the IRA. Emerging markets actually do not have that balance sheet, do not have the capacity to lower significantly the cost of providing clean energy technologies. Solar and wind are a different issue, but a lot of the other clean energy technologies is much more difficult to deploy, which is why there's so much call on financing the energy transition in emerging markets, because that's where probably we're going to meet or not meet our climate goals. Let me stop there.
Look, I love that you picked India as an example. We'll start with the power sector and then go to transportation. And in the power sector, I think the single biggest thing that India did to really transform its power sector was, these renewable clean energy technologies were rapidly plummeting down the cost curve, the S curve, and becoming cheaper and cheaper, and now are the cheapest form of energy ever in the history of humanity. I mean, it's like basically free electricity. The biggest thing that they did was to open the market and create price discovery through their auctions. And there's nuances of questions about whether the auctions could have been structured different ways, but at the end of the day, the price discovery process, as those economics changed, have really helped India on its path. And we've seen adjustment to their forecasted coal fleet on the basis of the simple economics of how cheap clean energy is and how attractive that is for investors and for policymakers. So how historically, what did the U.S. do to help India in its clean energy transition? Actually, the Sunshot program was really valuable, as it turns out, even though it wasn't intended to do that. The Sunshot program in the U.S., the feed-in tariffs in Spain and Germany, a bunch of hippies in Germany putting solar panels on their roof and creating public policy actually ended up helping Indian energy access because of making solar power really cheap, and then Chinese manufacturing. So what can we learn from that? A couple things. Let's start from the perspective of India on the oil question. India is an oil importer. If I were India, I would think about a couple other major economies that are oil importers that benefit from the shift to EVs. The balance of payments advantages, the macro advantages of quickly shifting to EVs are enormous for the Indian economy and the Indian government. And the interesting thing about that transition is for any of these emerging economies that have that choice and are oil importers, the shift of any of them to EVs will benefit the other ones. And then it's even more powerful if they were to do that in some kind of coordinated way. So I would be reaching out to other oil importing emerging economies and kind of figuring out how to do that. And once that kind of happens, that continues to drive EVs down the S curve, make those products more attractive for those markets, et cetera. So oil importer, this one's actually pretty easy on oil for India. And then flip it around. I'm an American. Think of it from the perspective of America. Luisa, I think you're exactly right. The implications of the IRA for emerging markets have yet to be determined. I am an enormous supporter of that piece of public policy, and I think it was exactly the right thing to do. And I think we haven't even fully comprehended how important it is for domestic and global decarbonization. But the unfinished business is the question of whether what I believe will be this rapid explosion of the zero carbon economy in the industrialized world, whether that will hoard capital into the industrialized world, because why would you search for a yield in emerging markets when you can find it in zero carbon opportunities in the US and Europe? The question is how we create the spillover from that investment in those emerging economies. And I think that's a really important unanswered question. We did it accidentally with solar. And I think we need to do it on purpose, especially because, as Luisa points out, timing is everything. And I think there's an equity component to that as well. So there really is a question, do we have the policy framework, do the international trade and investment framework, do we have the bilateral relationship framework to ensure that emerging economies benefit from this huge wave of very cheap, very productive technologies that also happen to emit zero greenhouse gases? And that's really the question. Do they get that productivity boost from those technologies or not? And so that's the kind of unanswered question. How we align our foreign policy for the US is how we align our foreign policy with our domestic industrial policy. And I would like to see that happen. And I'd like to see aid and climate finance and all of these apparatus really align with that. And I think that would really benefit the whole world.
Okay, lots to digest. Closing comment, something that we didn't touch on. I have roughly 2 minutes, maybe one to Luisa and one to Ilmi. And then if I don't get to thank you, please, thanks so much for coming and sharing your expertise with us. Luisa, first.
So there's something that we did not discuss that I do want to bring to the table. We have to think purposely about the retirement of fossil fuel assets as part of the capital investments that we need to do in the future. financing the energy transition is not only about the greenness of the green, it's actually also about greening the brown, because economic systems and the way we do things and those assets, just abandoning them is not going to help climate. And so thinking about orderly retirement, retrofitting of these assets, I think is part of the unfinished business of the energy
It's like
transition
taking
of
out the
oil and
old
gas.
Russian nukes, right, Ilmi?
Yeah, I mean, from the perspective of a just transition, I have to say I'm way more worried about garages that maintain internal combustion engine vehicles than I am about a particular location that's producing a fossil fuel, because the macro impacts of a shift to EVs and the lack of maintenance um, is so that, and the economic policy tools to manage that transition are very different. We're talking about structural unemployment and job transitions across the whole economy, education, not about sort of a targeted specific jurisdiction where we throw money at it. I do think that I do think the speed of this transition isn't going to be fast enough. So where I agree with you, Luisa, is that there are opportunities to accelerate the decommissioning of these assets, and financing that acceleration is really important. We're seeing some experimentation of that with coal, and it's going to be a tool that is going to be part of the recipe for getting as fast enough, because the capital stock's just not going to turn over fast enough on its own. And so I definitely agree with that. But I do think that the broader view of the just transition is bigger if we're gonna go fast enough. We have to look across the whole economy and whether it's prepared to make this kind of transition to very different jobs. We have this huge lack of trades skills in the U.S. right now because we're in desperate need of electricians, because electrons are the future. We're still going through the revolution that the discovery of electricity provided. It's now colonizing heat. It's transportation, and then heat's next, et cetera. So there are some structural issues that come from that we're going to have to address very quickly. So I do agree with that. But at the end of the day, and I just want to finish on this point, the oil industry had us looking for carbon prices and saying, look, we agree that if a carbon price comes in, there's a real transition risk for us. But at the end of the day, they were looking at the wrong part of the financials, because at the end of the day, it was on the revenue side that transition risk really arises, and it's the erosion over time of the projected revenues of their capital assets that is really where the transition risk hits. And they can keep distracting us with this potential hypothetical cost on the price side, but really what's happening is we have to have a really hard look and be asking those companies to show us their assumptions about demand and where they come from, and challenging them, because the projected revenues associated with those assets of that capex should be put into question. And that's the side of the financials that we actually have to look at if we're going to understand how to make good capital allocation. The question of the session in the industry is to really challenge those assumptions about the cash flows coming from those assets in a destroying
So this has been
environment.
hugely helpful. At the very least, it'll change what I say in my climate risk class in the fall. So thank you. You've been very helpful, at least to me, and I'm hopefully to some of the audience. Thank you again, especially Ilmi for tuning in from Sweden on your vacation, right? So I'm so sorry about that. Louisa, hopefully you're still in Morningside Heights or somewhere around me here. So thank you again. And no, I can't thank you enough. I think it's been incredibly helpful. I still don't think I've fully understood everything you said, but maybe that's an occasion for us to meet again next year and do this perhaps one more time. So thank you, Louisa. Thank you, Ilmi. Okay, take care.
It's
Ilmi,
great
nice to
fun.
meet
Thank
you.
you. Nice to meet you as well. Pleasure to be on the panel with you.